Hey everybody, it's Larry Berman here. Markets keep surprising to the upside here, but we really haven't seen a broad-based breakout yet. But we're getting closer in terms of the average stock performance. So let's dive into the chart room and see if we learned anything this week. S&P 500 on a year-over-year basis here. We haven't broken out to new highs yet, but if this rally was going to fail, it probably wouldn't have got this high. When we made a lower high and a slightly lower low, and we were talking about this big reversal a week ago off NVIDIA, and now the market's recovered. It hasn't made new highs yet, but it does tell us that we're basically, at an inflection point. When we look at the NASDAQ relative to the recent highs, we see a little bit more weakness on a relative basis compared to the S&P 500. So there's just a bit of an edge taken off on the tech side. A lot of that will be NVIDIA still that has, not made a higher high after that reversal last week, and in fact has sold off a little bit, offset by Alphabet and a few other names that have done a little bit better this week. When we look at the broader markets, so Russell 2000, again, we haven't made a new high in small caps yet, but it's getting there. So as we start December and as we start otherwise what would be a seasonal strong period, we got to be reminded that often December is strong and November is strong because September and October have been weak, and we didn't see that this year around. So the fact that November's bounced back to where it started is very good. But it's got to keep going and got to break out here. Now, one of the reasons why I believe that we have seen better bounce back is, what's going on in interest rates. So when we look at an equal weight S&P that's much more sensitive to, market rates and expectations, it's clear this week versus the previous week when it looked like the Fed wasn't going to cut rates in December 10th. It looks like now they're going to. So the long end of the curve rallied a little bit, not much, but off the sell-off in early November that caused some of that equity market weakness with yields rising. The long end struggled here, but we're now back to pricing in, when we look at interest rate probabilities, a higher than 80% chance December 10th that we get a rate cut. The chatter earlier in the week out of some key Fed members, we now have some insight to who the next Fed chairman is going to be. We know that person is politically motivated more than some of the other people who might thought have been to be leader. And so there's some expectation that happens. However, that person is not in place until the June meeting. So Powell's still in place for the next few meetings. As you can see, not even 2 rate cuts priced in over the next 4 meetings that Powell's still chairman. And then post-Powell, you basically have 1 more rate cut priced in, maybe 2 through middle of 2027. So the marketplace is not telling us the Fed is going to be overly aggressive here. When we started to see some economic data again this week, ADP told us the labor market's softening. The initial claims tell us there's not a lot of new firing. Continuing claims tell us it's a lot harder to find a job once you've been laid off. So there's definitely weakness in the employment side. The weakness is largely coming from the lower end. When we look at the differences in regional Fed beige books, it's clear some of the states with much more rural and less business sector, so much more blue collar, much less white collar type worker is where the struggle is really coming from. These things move very, very slowly and then suddenly at some point. It looks like there'll be enough stimulus from some of these checks that Trump is cutting now and some of the residual from the one big beautiful bill into 2026, that it's unlikely we see a recession. So there's some economic momentum. Definitely on the administration side, they want the economy to be strong in 2026. And so it makes sense that some more rate cuts coming as long as inflation's contained, but not a whole lot more. And so it looks to me like the money market side is priced correctly. Whether the long end breaks this range we've been in for a couple of months now, let me go back to TLT here, where we've just been chopping around in really a 25 basis point range in the long end. So does this break down or up? Well, again, it breaks up if we get a hard economic landing. It breaks down if the economy runs hot and inflation is coming. So the long end's telling us we don't know. We're smack dab in the middle of that range. And the front end's telling us only moderate rate cuts to come, and it doesn't matter who the Fed chief is going to be. So that's kind of the message I took from the market. That's Goldilocks-like in a sense, so not surprising that I guess that equity markets have recovered back towards new highs, although we haven't seen any breakouts. For this market to keep going higher, we do need to see equity markets make new highs here. Again, that's not the bet I would be making today, but that is what the message will be if we see that. Anyways, that's all I have this week. Have a great one, everyone.